Hello, everybody. Welcome to the Enlightened Investor. Wow, we are in the week of our first interest rate hike in 2 years. So we're moving away from expansionary monetary policy to contractionary monetary policy. And I'd like just to spend a few minutes with you talking about why are we raising rates? How does the Federal Reserve do this? Let's talk about how interest rates are forecasted. I've got some great forecasts for you, how far I think interest rates are going to go up this year, maybe even next year, and then maybe some investor takeaways, which is Mike's favorite thing. So before we start, let's go ahead and take a look at some quotes of the day because we're talking about money and interest rates. So we have to bring up a Rothschild for sure. And Rothschild, Mayor Amschel Rothschild says, "Give me control of a nation's money supply, and I care not who makes its laws." And that is a very powerful statement. And we know that the Federal Reserve System controls our money supply, our interest rates. I met Robert Dole one time. He was a senator from Kansas, and he was actually, I think, campaigning for president. And he said at this event I was at, he said, the second most powerful person on the planet is the Federal Reserve Chair. And I think Rothschild would definitely agree. The second quote here is from Alan Greenspan. And he says, "In absence of a gold standard, there's no way to prevent confiscation of savings through inflation." And Ryan and I were talking about this just right before the show started today, that prices of just things are just going up, and he's making conscious choices. You know, he's got a family now taken care of. He's got a budget like we all do, and he's just trying to optimize. And so, what's going on with this, inflation? And without an anchor, like the Fed can really crank out the money supply, and it takes about 2 years for a dollar or a loan that's been put into the economy to make its full impact on the society. So it's going to take a little while for this inflation pressures to kind of dampen down. Let's take a look at inflation pressures right quick. And here's a graph that just came out last week of the inflation rate over the last 12 months. And you can see that if you add up from February of 2021 to February 2022, this is about a 7.9%, roughly 8% increase in prices. So, using the rule of doubling, it's only going to take 8 years to double prices. I mean, think about that. 8 years for your $100 to really go down to 50 in purchasing power. So we're hoping what we're going to see is that after the war, and we talked about this, if you want more on inflation, go back a couple episodes. You can watch our episode on inflation, but look for inflation to kind of settle down a little bit after the Ukraine-Russian conflict, but to be elevated for a little longer than we want. So let's talk a little bit briefly about the Fed and how they get inflation under control. So the last time we really had inflation problems was really in the 70s and 80s when Volcker came around. And the Federal Reserve has a tool, this group of individuals called the Federal Reserve Open Market Committee. It's a group of 12 bankers, essentially, 7 board of governors and 5 presidents of the Federal Reserve districts. And they get together and essentially set monetary policy so they can set how much bonds they're purchasing, the interest rates, which we call the federal funds rate. And the federal funds rate is the rate that's sort of like a base rate. Like our mortgage rates are all kind of based on this foundational rate. It's the rate in which banks loan each other loans, right? So it's the Fed funds rate. Banks might have a little extra reserves, they might take some of these excess reserves and loan it to another bank. And so right now they're really getting at 0.125 to 0.25, kind of that range. So we're looking at Wednesday this week, we're looking for maybe a 25 basis points increase in this rate. And all other rates are predicated on that. So think about, your student loans and your 5-year loans and on up to your 30-year fixed loans, even 50-year fixed loans they have now. So those are set really at the foundation level at the FOMC federal funds rate. And you can see there, here's a graphic of the FOMC, how they vote. There's 12 members of this voting committee. So 12 of them are board of governors. The board of governors have a 14-year term. And then there's 5 of the 12 regional presidents. They get together and they go ahead and they vote on optimum monetary policy. So let's take a look at where we think federal funds rates are going. And we're going to use a couple of tools here. We're going to actually go back and use what's called the dot plot. So the dot plot comes from the Federal Reserve's Board of Governors and the FOMC, and they provide a forecast for us. And then we'll also go ahead and take a look at the Atlanta Federal Reserve. They kind of have some of their own forecasts. Now, I know that you can look at other forecasts from like JP Morgan Chase. You can look at forecasts from Goldman Sachs on where interest rates are going. But let's take a look at what the Federal Reserve of Atlanta has to say. So first off, let's take a look at where we were. The first dot plot I want to have you take a look at here is the forecasted appropriate federal funds rate that the FOMC came out with on September 22nd of 2021. And they do these forecasts 4 times a year. So we're going to get another forecast here in March. We got one in December. I'll show you that one in a second. And this is the two times ago in September. So you can see here that in the long term, if you look over the right-hand side, kind of glance your eyes over the right-hand side, in the longer term, what we're looking at here is these are these dots. These dots are the members of the FOMC who are voting for what they perceive or forecast interest rates are going to be in the long run. So in the long run, they're projecting 2.5% Fed funds rate. And today it's really at 0, right? So that's where we're going in the long run. Take a look at 2021. You can see there, those are all 0 dot plots. 2022, you can see a few members of the FOMC voted for raising rates to like 0.5% or 0.75. And you can see as there's a gradual upward sloping of the interest rates on this dot plot. Does that make sense? Let's take a look at the December one. You can see the December one, how this has changed. Notice how when I went from September to December of 2021, the interest rate dot plots, the forecasts of those FOMC members, all had higher expectations. So the long run over on the right-hand side still is at 2.5, but take a look at 2022. They're projecting roughly about 0.75 to 1%. And in 2023, there's really not a really consensus there. But I just want you to see that the difference between September and December is a very quick change, a very rapid change for interest rates. Anyways, here's the Federal Reserve of Atlanta's federal funds projection. What I want to show you is here's what we're projecting. We're projecting that interest rates at the end of this year and in December of 2022 are going to be about 1.5 to 1.75. So if you consider that the FOMC meets 9 times a year, they already met in January. They're meeting in March here. So we'll have eight additional meetings yet. If they raise rates 25 basis points every meeting for 8 straight times, that'll get us up to 2%. I don't think they'll quite do that. More likely a 1.5 or so for this year. Next year, at the end of next year, in December of 2023, the forecast is for about 2.25%. You can kind of see there's that variation there at that federal funds rate from Atlanta. So how about the investor takeaways, right? This is what your takeaway is, right? You always want to get to the good stuff, Lure. Okay, let's get to what does it mean for me as an investor. Well, first thing is I want to show you that this very critical takeaway is that the S&P 500 or the market doesn't always go down with interest rates rising. All right, as Fed funds rate has risen in the past, this is a graph here of the last 10 years. You can see there that interest rates rose from 2016 to 2019, and yet the market went up. So it is a negative influence, interest rates moving up, but it doesn't mean that the markets will have diminished returns, all things equal, right? So remember what the market's like. They like slow and moderate growth. They like stable prices. They like low levels of uncertainty and strong earnings. But the other thing they like is a growing Federal Reserve balance sheet. And for the first time, my friends, in 2 years, the Federal Reserve balance sheet is going to start to slowly shrink. And that will have some pressure on earning for, bringing back present values. But But note that, as Ryan and I were saying right before the show, is that the world is a very uncertain place. Definitely put your investments, your savings into investments that grow. Stick with your plan, and doesn't feel great having ups and downs and these uncertainties. But the idea is just to hang in there, because I'm doing the same thing, folks. Ryan's doing the same thing. So if you like the content today, please hit the like and subscribe to our show. Visit us at enlightened-investor.com, and we'll see you next time. Thanks, folks. Take care.